Welcome to Fund to Money, your 24/7 buddy on all matters related to personal finance. In this web series, we are discussing various things you need to keep in mind while investing in stocks. That's right, we are talking about stock market investing. Of course, we are very well aware that there are perhaps a billion videos out there telling you how to invest in stocks. But here our objective is very simple. The idea is to empower you, make you into a smart investor, including investment in stocks. In a little while, we are going to start discussing various things people need to keep in mind when people get information about a company raising debt, which is a loan, a business loan, or say a bond issue, a bonds issue. So how should an investor be looking at it? Well, as I was saying, on and off you get this information about a company raising debt. It could be a bond, it could be any kind of a convertible kind of an instrument, and you get this information in a newspaper, in a say a mobile update or something like that, or perhaps in a television program. Now, what should an investor be making out of it? Whether the person has already invested in the stock or is looking at investing in that particular stock. Now, with us there is stock market expert Mohit Satyanand, who will help us figure this thing out. Hi Mohit.
Hi Uday.
Mohit, companies have to raise money, okay? So they can either do it through fresh issue of shares or through some kind of a loan or debt. And at a broader level, I mean, some of these finance students would say that this is the capital structure. Now, but putting it very simply, a company comes and says that, okay, I'm going to raise debt. What should the investor be looking at?
I think you need to look first at what is the kind of return on capital employed that a company makes. If the return on capital employed is higher than what the company is paying for its debt, then it's a positive thing, because the difference is going to become a return to the shareholder, right? So as Udayan said, most companies do raise debt in order to expand. I think the danger signals are, number one, if you raise too much debt, and as a result you become vulnerable to fluctuations in the economic cycle. And the number or the index that helps you decide this is what is called the debt equity ratio. It's a number that you'll find in most analyses of a company. It's very difficult to say that this is a number at which you should get worried, because companies which are in the infrastructure space, for example, tend to have very high debt equity ratios. They can be as high as 6:1, but that's precisely why these companies become very vulnerable to economic slowdown. Personally, I start getting a little worried when debt equity ratios run over 2:1. But I think every time you do look at debt equity ratio, you need to remember, go back to what is the return on capital employed of this company historically.
So Mohit, when you're talking about return on capital employed, let's try to break it up into two parts.
Yeah.
One is the capital employed. So that means if I were to be a company and I have distributed shares, so that's one part of the capital. And if I've taken loans from people or companies, that's the other part. That's right. Capital, right?
That's right.
So that capital has been employed in running, setting up the company and running it. And what is out of that capital, what is the return I'm getting?
That's
so
right.
This return on capital employed, people can get it.
Oh yeah. It'll be there in ratios in most analyses, okay. Whether it's a money control or typically a company will have it in its annual report. You can download the annual report from
or say
from
a BSc or something.
Yeah. It's all available. So very simple. If on average a company has a return on capital employed of 25%. Mm-hmm. And it's raising debt at 15%. As a shareholder, you should be very happy, because it's going to make 10% for every extra rupee of debt that it's raising. Mm-hmm. Unless it's suddenly getting into a cycle which is a defeating cycle, or you're worried about it's going into areas where it can't guarantee the return on capital. But I think to look at debt equity ratio as being something that worries you, in the absence of knowing what historically the return on capital employed is being very foolish.
Well, that's a wonderful explanation, and obviously Shakespeare isn't working here in these. He said something like, "Neither be a borrower or a lender be," and stuff like that. So that doesn't really work. But in terms of stock market investing, this is something that one needs to look. When you're into equity market investing or stock market or share market investing, you can choose whatever name that you want to give. You need to also be very smart about what's happening about companies' borrowings. So we hope you found this information and this explanation useful. If you've liked it, please go and click on the like button. And if you're liking this web series and the other stuff that we've been putting across, please subscribe to our channel. And of course, in the comment section, please don't forget to give in your comments just in case we missed out something. And of course, keep following the description section of this particular segment, because all the edited transcripts are going to be right there.